friends, I'm Rebecca. Welcome to Squintillions. For the past year and a half, I've been using an investment strategy, covered call writing, to generate income in both my IRA and my taxable brokerage accounts. My approach is known as portfolio overwriting, since I intend to keep the underlying shares that I'm writing the calls on. If these terms are foreign to you and you are apprehensive about trying out this strategy, stick around because I'm going to explain the basics of how it works. In 2021, I earned over $7,000 in covered call premiums. Listen up to learn how you can earn extra income in your portfolio and minimize your risk when writing covered calls. This video is for educational purposes for those interested in learning about covered calls and hearing about my experience. It is not intended as personal financial advice. In order to sell covered calls, you will need to have options trading approval in your account. Each brokerage will have different levels of options approvals and guidelines on who will be approved. Covered call writing is typically within the first level of approval, so getting approved should be straightforward for most investors. Currently, TD Ameritrade and Webull both allow trading of covered calls and cash-secured puts in their first level of options trading. E-Trade doesn't allow cash-secured put trading with level 1 approval. So if you are interested in selling cash-secured puts or trying the wheel strategy, you'll want to get started with a different brokerage as it is more difficult to get the level 2 approval as a beginner. You will also need to own 100 shares of a single stock or ETF that is available for options trading, or have enough money to buy 100 shares, as one call contract is made up of 100 shares. When you are writing a covered call, you are selling a contract to another investor that gives them the right, but not the obligation, to purchase a stock you own at a specific price, known as the strike price, on a specific date, or possibly earlier. The fact that you already own that stock is what makes it a covered call. Since you already own the shares, you know the cost basis of those shares, which will be helpful in determining the strike price you want to use when you write the option contract. When you sell a covered call, you receive a premium. The premium is basically the cost of the contract, which the buyer of the contract pays to the seller. When I'm going to write a covered call, one of the first things I think about is what price I would be comfortable selling my shares at if the shares were to be assigned. Being assigned means that the stock price goes higher than your chosen strike price. This is called in the money. And your shares are sold from your account at that strike price. Assignment is triggered for in the money contracts after the close of the market on your expiration day. The transaction can be made earlier if the stock price goes a lot higher than your strike price, or if it is in the money, even just a little bit, around an ex-dividend day. In this case, the person on the other side is calling that option in order to own the shares in time for the ex-dividend day and then get the dividends on those shares. That has happened to me a couple times. One way to avoid that is to not place covered calls to run over an ex-dividend date. You can modify the risk by choosing a much higher strike price and an expiration date that is not during the same week as the ex-dividend date. So it is less likely your call will be in the money at ex-dividend time. If the stock price is below the strike price on the expiration date, the contract expires worthless and you keep your shares. I'm going to use the company Intel as an example, since I have 100 shares of Intel in both my TD Ameritrade IRA and in my E-Trade taxable brokerage account. It's good to have a real-world company that I've had some experience with regarding covered calls to use as an example. This is not a recommendation to go out and buy Intel. The first thing I look at when deciding on a strike price is my cost basis. In my IRA, my Intel shares have a cost basis of $47.05. In that account, I would always choose a strike price that is higher than that, and I wouldn't sell a call for lower than a $48 strike price. The second thing I look at is the current stock price and the range the stock has traded in over the last 6 months. Since Intel's earnings report in late January, when the stock price was knocked down on the guidance given because of supply chain issues, the stock has been trading between about $48 and $50. Earlier that month, it had almost reached $56, but now it is closer to its 52-week low. Next, you must decide on the balance between the premium you will receive and the risk of having your shares assigned. What is your goal? Do you want to collect a high premium and don't care if the shares are assigned, or that the stock price might go higher after your shares were sold? Keep in mind, if the stock price goes above your strike price and you get assigned, you don't benefit from any additional appreciation in the stock price. That scenario has happened to me a few times, though mostly on ETFs, or when there have been major surprise news announcements from a company. I haven't had as much success writing covered calls on ETFs, so I preferred using individual company stocks. Using Intel as an example again, back in January 2021, when it was announced that Bob Swan was resigning as CEO of Intel, the share price increased, and I decided to roll my call that expired in January to February and roll up the strike price from $55 to $56. On news in February that Pat Gelsinger would take over as CEO, the stock price bumped up again. My shares ended up being assigned before the expiration date, when the stock price reached $58.88. I made a profit of $2,155 on the sale of the 100 Intel shares. I had also received $39 in premiums, which included the original covered call premium and the credit for rolling it out and up. You could argue that I missed out on the potential gain of at least $288 when the stock price increased above my strike price. This kind of thinking borders on hindsight bias. When you are selling covered calls, you should believe you are making your best choices based on the information you have when you are writing the call. Sometimes unpredictable things happen, and you shouldn't feel remorse about your decisions afterward, provided you're trading according to your own guidelines. When I sold the covered call on Intel, there was only a 6% risk of it closing in the money. Be careful that when investing, you don't what-if yourself into a decision paralysis. In the end, I was glad to lock in the profit on these shares and then have some money freed up to make another investment. Also, as time passes, you can look back from a different point in time and come to a different conclusion. Right now, Intel shares are trading under $50, and you could decide it was smart that I sold mine at $56. Most of us can agree it is extremely difficult to time the peak price of a stock. For me, the important thing is that I am profiting enough from the transaction to make it worth my time to write calls. Let's go back and discuss more about rolling calls. Rolling out a call means that you are buying back the original contract you wrote and then immediately selling another one on the same stock for a different date. If you are buying back because the stock price is at or above your strike price, it will generally cost you more than the premium you earned to buy back the contract. But then you can sometimes sell your new contract at a higher premium than it costs to buy back, so you get a credit on the roll. This doesn't always work out. It depends how far out on the calendar you are willing to go and the volume of options contracts in play for that stock. When the stock price is getting close to the strike price or just above it, I tend to roll the call up to a higher strike price and further out on the calendar. Usually, the further away the expiration date from when you are selling the call, the higher the premium you can collect. After you sell a call, time decay will erode the value of the contract, and given the stock price holds level, you will see the premium amounts to sell or buy back that same call will decrease over time. However, if the stock price increases, it will negate the effect of the time decay on the contract's price. You may hear the term theta used to describe how much the value of an option declines in the passing of one day while the stock price remains level. Theta isn't a number I look at when selling my calls, but is useful to understand the time element of an options contract. Feel free to further research theta if that interests you. I like to sell my calls with an expiration date of 3 weeks to 2 months in the future. This allows for a reasonable level of premium, but minimizes the risk of greater volatility as you move further out in time, and more unknown and unanticipated factors can impact the future stock price. Sometimes you might want to let your shares get assigned if the stock price goes up and you feel comfortable with the price you selected. Some people think of writing covered calls as if they are getting paid to write a limit order. You can certainly use them like that if you have a stock you want to offload, but don't need to sell immediately. Unless you are able to completely detach your emotions from your trades, you'll know as it gets close to the expiration date what you truly want to do with your stock, because your brain will tell you yes or no based on how you think the market will go. You'll either be glad that the stock is being sold or worried that it is being sold. Maybe you are like me and you would rather hold on to your shares for a long period of time. In an IRA, selling in and out of shares doesn't matter as much because there aren't the tax implications that there are in a taxable brokerage account. In my taxable brokerage account, I like to set higher strike prices on my covered calls, though earning a smaller premium. There is a lower risk that the stock price will go over the strike price. Then, there is less worry about having my shares assigned or having to roll or buy back the options in order to keep my shares. Note that if you are earning premiums on covered calls that expire in less than a year, your premiums will be taxed as short-term gains. Also, be aware that the gain is realized when the contract is closed or expires. If you wrote a call in December 2021 for January 2022 and got paid a premium in December, if you didn't close the call until January, the tax on the gain or the credit for a loss will apply to the 2022 tax year. Buying back the options is another choice you can make at any time during your contract. I actually prefer to buy back my options rather than let them expire. This is another strategy that I use to reduce risk. Buying back an option means that you pay money to close your options contract without selling a new contract. I typically wait until the buyback price is less than 20% of the premium, and usually less than 10% of what I received to sell the contract before I buy it back. For example, if I received a $50 premium when I sold a covered call, I will think about buying back the call when the cost to do so is $10 or less. I do consider commission and transaction fees when buying back calls. At TD Ameritrade, buy orders under $5 for the contract. You're paying 5 cents per share to buy it back. Only cost 1 cent instead of 66 cents above that price level. Selling a call at TD Ameritrade always costs 66 cents. My E-Trade account costs only 1 cent to buy back orders under $10 for the contract versus paying a fee of 51 cents above $10. Selling a call on E-Trade always costs 52 cents for me. Webull's options trades are commission-free for shares listed on U.S. exchanges, but there are various minimal transaction fees that all the brokerages are assessed. I don't think I've ever paid more than 10 cents to sell or buy back a covered call on Webull. Looking at the premium return on an option, my typical range tends to be between 0.5% and up to 2% per options contract. Of course, the percentage I expect to get back varies for each stock and sometimes is more or less than that. It is easier to get a higher percentage premium for a similar level of risk on a growth tech stock than on a dividend earning consumer staple stock. Anything above a 2% return on option usually means the risk level is probably too high for me. I like to keep my risk level that the options would close in the money below 20% for most covered calls I write, and ideally under 10%, as I want to hold on to my stocks. There are some exceptions to this rule. For example, if I have decided I want to sell out of a stock, I will write a call that is more likely to hit the strike price and will have a higher risk level of being in the money. There are tools on the brokerage platforms to show you the risk analysis based on the current stock price and your intended call order. Input your details and you will get a calculation of your call being in the money at the expiration date. Remember, this is a snapshot in time. The risk level will fluctuate, just like the stock price does. I like to use E-Trade's Option Analyzer tool for this. It has a profit-loss graph where you can see a bell curve of the stock price and slide a bar to different strike prices. It calculates the percentage chance of your stock closing above and below your chosen strike price. Some people also like to use the delta value to help determine risk. Delta is written as a number between 0 and 1. As delta moves closer to 1, there's a higher risk of the call being in the money at the expiration date. You could set a delta limit for yourself when you are selling calls. For example, not selling any calls that have a delta over zero point 0.4. The delta value can be difficult to find on some trading platforms. For example, in E-Trade, you need to launch Power E-Trade to see it, and then scroll across the bottom of the options window to get to the delta column, or remove the put column to see it. If you don't want to use Power E-Trade, the percentage given for your option closing above the money using the Option Analyzer tool is close to the delta value, except it has been rounded to a whole number and expressed as a percentage rather than a decimal. Think about how or if you want to use delta when placing your trades. If you want to reduce your risk of assignment, you'll also want to avoid selling calls that run over or expire close to a company's scheduled earnings call date. Quarterly earnings reports can cause additional volatility on stock prices, as we have especially seen in recent weeks. Companies may make big announcements during their earnings calls, such as acquisitions, spin-offs, changes of leadership, shifts in business direction, operational problems, massive sales growth or declines, restructuring, expansions, etc., any of which can cause the stock price to rocket up or plummet.
Now we're going to explore the option chain for Intel using the TD Ameritrade website.
You can sell weekly options for many companies, but the monthly options, which expire on the third Friday of the month, tend to have a higher volume of people buying and selling calls. This means if you're trying to sell a call, you have a better chance of finding a buyer for a call that expires on the third Friday. If you want to buy back your calls, it will be easier to do so when there is a higher volume of calls being traded. When you are looking at the options chart, notice the volume column. This can help you see how much trading is going on at each strike price level. Usually you can imagine the bell curve from the numbers given, and it will help you find the middle strike price of what other options traders are shooting for on any given expiration date. Some people recommend not trading an option if the volume is less than 100. On a few stocks, I'll drop that limit to 50. When selling a call, in most platforms, you can click on the bid price in the option chain to start your order. From there, you can set a market order or a limit order for your call, just like you can when buying or selling stocks. I use limit orders and set my sell price for the premium I will earn to be somewhere between the bid and the ask price. You can get a little more premium that way. You can make your limit order at or near the ask price, and then revise your order price down every 15 minutes until it sells. Of course, sometimes the stock price will start sinking and you will miss your chance at the slightly higher call premium. Again, this is up to you as to whether you want to sell the call right away at the bid price, or if you have some time to take a chance on making a little extra premium. You might also decide on your call sell price based on if you think that stock is about to go up or down in price. Maybe you read some news just as it was issued and you anticipate a particular movement in price direction that might affect options premiums. Try to keep in mind your goals in selling covered calls if you're going to strategize selling your options and attempting to time the options market this way. When you are ready to place your order, always carefully read the order before you hit the submit button. Double check the strike price, the expiration date including the year, and the premium price. You don't want to make a typo or a mistake here, especially if you elected to place a limit order and name your premium price. How do you choose which stock you want to use for covered calls if you don't already own a stock with 100 shares? Time to do some research to help you decide how much money do you have to spend. This may limit your choices, and you may need to narrow your potential buy list based on stock prices, since you will need to buy 100 shares of each stock. Are there any companies that you would like to own shares in? Make sure you do your due diligence when choosing any stock to buy. Look at the fundamentals, read through recent press on the company, check earnings reports, and review specific statistics that might be important to you, such as PE ratio, earnings per share, beta, current ratio, revenue trends, cash flow, and dividends. Use the stock screener tool in your brokerage to help you create a list based on your personal criteria. You can then cross-reference this with an options screener to help you find stocks that would be good for writing covered calls. Barchart.com is a useful website for options research, though you will need to pay for a membership to access all of the features. One word of warning is to not chase high premiums if you are writing covered calls, and especially if you are looking at premiums to help you decide what stock to own to write calls on. Always ensure that the company you are selling calls on is one you feel comfortable holding in your portfolio. You don't want to go after a high premium one time only to lose out on your initial investment because the stock price drops drastically. I like to keep track of all my options activity in my own spreadsheet, particularly because I am working with multiple brokerages. I make 2 tabs for each brokerage, one with call orders that are waiting to be filled and those that are currently active, and the other tab has calls that have been closed in the last year. This way, I can easily review previous calls for a company when I'm writing a new one. I've set up my spreadsheet to keep track of factors I'm interested in that I use when writing a call or will want to look at later, such as the stock's 52-week high and low, the price at the opening of the call, strike price, expiration date, premium received, the return on option premium as a percentage of my cost basis in the stock, the stock appreciation upside and percentage if the stock sells at the strike price, and the percentage probability of the stock being in the money when the call is sold. I also keep track of the dates when I open and close the call. When I close the call or it expires, I record the stock price at the time the option was closed. Then if I bought back or rolled the call, I will record the exit price per share, the exit price for the contract, and any fees paid, so I can calculate the final profit or loss figures on the option. I also keep a list of earnings, call, ex-dividend, and payout dates for the companies I sell covered calls on. I hope that this video has helped you to understand covered call writing and given you ideas and strategies for generating income writing calls. In the future, I will be creating some tutorial videos on how to place covered call trades on the 3 platforms that I use: E-Trade, TD Ameritrade, and Webull. If you don't have a Webull account, I've got an affiliate link in the description below to sign up. That was the easiest account of the 3 to apply and be approved for options trading. Leave a comment below and let me know if you are new to covered calls, or if not, how long you've been trading options. If you made it through this whole video, please hit the like button. And if you haven't already, please subscribe for more content on personal finance and personal growth here on Squintillions.